In this video, we're going to discuss the accounting for byproducts. Byproducts are outputs of joint production processes that are relatively minor in quantity or value. For our Carlisle Coal Company example, our byproduct will be coal dust. In the timber industry or lumber industry, quite often sawdust is a byproduct. In the foods services industry, we have quite a few byproducts in the slaughtering of beef, the slaughtering of chickens, and those byproducts end up in other types of household products and or pet foods. Again, this video will discuss the allocation of those joint production costs and how we allocate costs to byproducts. There are really two methods for allocating costs to byproducts. The first method assigns a cost equal to the byproduct's value. In this case, the net realizable value from the sale of the byproduct is deducted from our joint cost before we allocate any cost to our main products. And of course, when we sell the byproduct, we will realize no profit as its relative sales value equals the cost we've assigned to it. In the second method, we assign no cost to the byproduct, and the proceeds from the sale of the byproduct are simply treated as other revenue in the period of the sale. Let's go ahead and walk through an example. Our example is for the Carlisle Coal Company that had joint production cost or joint product cost of $270,000, and we produced, recall, two different main products, high-grade coal and low-grade coal. But in the process, we also create coal dust, which we think has a market value of $15,000. We're first going to walk through method one, and we're going to use our net realizable value or market value at the split-off point. So our starting point is to pick up the relative market values at split-off points for the high-grade coal, $300,000, for the low-grade coal, $450,000. Notice again, the combined market value of those products is $750,000. The dust is 15 for a total of $765. Now we're going to allocate cost to the high-grade coal and the low-grade coal based on their relative sales values. The high-grade coal we expect to sell for $300,000 out of the total market value for the two products of $750,000. So we'll allocate 40% of the joint product cost to the high-grade coal. The low-grade coal accounts for $450,000 of our expected $750,000 in sales value at the split-off point, or 60%. So we allocate it 60% of the cost. In method one, we assign a cost equal to the expected sales value of our coal dust to the byproduct, which means, of course, instead of allocating $270,000 in cost to the high-grade coal and the low-grade coal, we will only have a cost of $255,000 to allocate to both products. We will assign a cost of $102,000 to the high-grade coal. That's the $270,000 in joint product costs, minus the $15,000 in cost we've allocated to the coal dust, multiplied by our 40% allocation percentage. We will assign a cost of $153,000 to the low-grade coal, which is the $255,000 from remaining costs multiplied by 60%. We sum our row to be sure that we've picked up all $270,000 in cost. We can now calculate the gross margin for each product. We're going to have $198,000 in gross profit on the high-grade coal, and that's simply the $300,000 in market value at the split-off point minus our $102,000 in allocated cost. The low-grade coal has a gross margin of $297,000, and notice the the byproduct, the coal dust, has a gross margin of 0 since we allocated a cost equal to its expected sales value. And of course, we can calculate our margin percentages for each one of our products. 66% for the high-grade and low-grade coal, since we've allocated based on relative sales values, and no margin on the coal dust, and overall a 65% gross profit margin. Let's now go ahead and consider our cost allocations under method number 2. Again, our starting point is to pick up our net realizable values, or rather market values, at split off point as it's more properly called, of each one of our main products and the byproducts. Next, we're going to allocate our $270,000 in cost. Our cost allocation percentage, again, is 40% for the high-grade coal, which is our $300,000 divided by 750. For the low-grade coal, it's 60%. Let's go ahead with our cost allocations. Again, we've assigned no cost to the byproduct in this example, so we're going to assign the entire $270,000 in cost to the high-grade coal, and 60% of the entire $270,000 in cost to the low-grade coal. And again, no cost to the coal dust, and we've assigned all $270,000 in cost. So again, the only difference between these two examples is for method 1, we're allocating a cost of $255,000, which is the $270, minus the $15,000 in cost we've allocated to the low-grade coal, or rather the coal dust. In method 2, we assign no cost to the coal dust, so we allocate the entire $270,000 to the high-grade coal and the low-grade coal. Continue on calculating our gross margin for each product, as well as the gross margin percentages. Notice again the gross margins are the same for each of our high-grade and low-grade coal, and our margin on the coal dust is 100% since we've assigned it no cost, and our overall gross margin remains the same. Now we're going to walk through essentially the same process, but rather than using our relative sales values at split off, we'll use the net realizable value if processed further. Let's begin by picking up the final sales value for the high-grade coal, $300,000. We haven't processed it further. The low-grade coal will now be worth $550,000. This coal dust is still $15,000 for a total of $865,000. We're going to deduct our additional processing cost. We aren't processing the high-grade coal. The low-grade coal, we incur an additional $50,000 in processing. Nothing on the dust for a total of $50,000. The net realizable values then are simply our sales values minus the additional processing costs. The high-grade coal, $300,000. The low-grade coal, $500,000. The coal dust, $15,000, for a total of $815,000 in value. Next, we calculate the allocation percentages, and again, those are using the relative sales values after further processing of our high and low grade coal. So 300,000 over 8 and 500,000 over 8. So our allocation percentages, 37.5% will be allocated to the high grade coal, and 62.5% of our joint product costs will be allocated to the low grade coal. Again, recall, in method 1, we assign a cost equal to the byproduct's relative sales value, and so we will only have, instead of $270,000 in cost to allocate to our high grade and low grade coal, we will have $270,000 minus 15, or $255,000 in costs. So the high grade coal gets allocated 37.5% of that $255, or $95,625. The low grade coal will get allocated the other 62.5%, and our total allocated cost is $270,000. And of course, we'll take our net realizable value minus the allocated joint costs to calculate our gross margins. The gross margin on high grade coal will be $204,375. For the low grade, $340,625. For the coal dust, nothing, since we've allocated a cost equal to its expected sales value, and a total of $545. In method 2, we're going to go through the same process, but this time we will assign no cost. So we pick up the final sales values that were given. We subtract our additional processing cost. We aren't processing high grade. The low grade will cost $50,000. We aren't processing the coal dust, and we have a total of $50,000. The net realizable values then are again the 300, the 500,000, the 15, and the 815. We need to calculate our allocation percentages. The allocation percentages will be our final net realizable values of 300 and 500 divided by our total net realizable value of 500,000. So we will allocate, once again, the same 37.5% to the high-grade coal and the same 62.5% to the low-grade coal. The only difference is, this time we're allocating no cost to the byproduct. So rather than allocating $255,000 in cost, which was the $270 minus the 15, we allocate the entire $270,000 cost to our high-grade and low-grade coals. 37.5% goes to high-grade, and 62.5% goes to the low-grade. And again, nothing went to the coal dust, and we've allocated the entire cost. And once again, we can calculate our gross margin by taking our net realizable value minus our allocated joint costs. We get $198,750 for the high grade, $331,250 for the low grade, and of course a $15,000 or 100% profit for the coal dust, since we've allocated no cost.